All and welcome to the East Bay Regional Park District's Board Finance Committee meeting of September 28th. The purpose of conducting this meeting is based on Governor Newsom's amendment of the Brown Act so that we could have hybrid board meetings. Today, our meeting is entirely via teleconference, but you are welcome. If you are here as a member of the public, we welcome your comments and questions. And Shannon, could you tell folks how they could access public comments and commenting on some of the things we're talking about?
Yes, definitely. So public are welcome and encouraged to comment via this Zoom meeting. You can raise your hand by submitting an email or by leaving a voicemail. And all of the information on how to do that is on our agenda, which is located at the Park District website, ebparks.org. And to start, I'd like to go ahead and take roll.
Great, thank you.
Thank you. Chair Waspy.
Here.
Director Wieskamp.
Here.
And Director Eccles.
Here.
Great, thanks. And if Assistant General Manager Deborah Acker will introduce Park District staff participating in this meeting.
Thank you. I can do that. We have with us today AGM of HR, Allison Cook, Deborah Spalding, Assistant Finance Officer, Anna Huang, Assistant Finance Officer, David Sumner, Audit Manager, Kim Belingit, Accounting Manager, Christina Crosby, Budget Manager, Tao Von Sepan, Admin Analyst, and David Callboy, Admin Analyst. I think those are the main finance staff. There are some other members of the district participating as well.
Great. Well, welcome everyone. And our first item of business this morning is the annual report on the Park District Pension Trust. Deb, are you going to handle that?
All right. Hi, everyone. Deb Spalding, Assistant Finance Officer. I'm going to share my screen and make this into a slideshow. Can you guys see this all right? Is that working? Cool.
Yes.
All right. So I'm going to start out. This is an informational item. I'm going to start out by giving a little overview, some context, and then I'm going to turn it over to our experts who are here from PARS, Public Agency Retirement Services. So we have Mitch Barker and Andrew Brown who are here, and they're going to give you some more details about the trust. So first, I'll give you some overview of CalPERS and our miscellaneous pension plan. So the Park District, all of its employees are now part of CalPERS retirement plans. So permanent employees, when they retire, they're going to be getting some annual income from CalPERS. So we want CalPERS to remain strong for our employees. It is the largest U.S. public pension fund with about 2 million members. So going back in time to 1998, things were going great in the stock market. I think CalPERS had invested in real estate, and real estate was doing really well. And it was 138% funded. And at that time, all the different member agencies of CalPERS made decisions to expand benefits because it looked like that would be doable without increasing costs. And I remember I was an intern at the city of Oakland and people were marching around with placards that said 2.7 at 55. I had no idea what that meant. Now I do. So anyhow, benefits were expanded significantly, thinking that that would be sustainable. But then there was the dot-com bubble, the Great Recession, and CalPERS dropped to 61% funded, which was quite alarming, and it caused for the contributions from the different member agencies to have to increase significantly. And it was quite a hardship for cities and all the different agencies that participate in CalPERS. In addition to the hardships they were already facing from decreasing revenue, suddenly they had this new retirement pension cost. So a lot of reform was implemented. PEPRA is the one that we most commonly hear about, where all new employees now, I think it's starting in 2010, join at a lower retirement rate. So things have been going well in the stock market for a few years. And in 2021, CalPERS achieved 80% funded status. And what they had baked into their plan is when they got to a strong funded status, they were going to do some more de-risking and invest in safer investments with a lower volatility. So CalPERS is also taking steps to solidify. And then we had this last year, which is continuing today with more stock market volatility. So losses of 6.1% in the last fiscal year. Now our funded status is down to 71%. So all this is to say it's a real roller coaster. And we saw this happening, and we could see that it was going to continue happening. And so we set up this pension trust, and then this little square down here, I'm not sure if you can see, each year from CalPERS, we get an actuarial report where they tell us different scenarios, what if this happens. And one of the what ifs is what happens if there's a 1 standard deviation loss or a 2 standard deviation loss. And we roughly got like a 1 standard deviation loss. And so we have to make this unfunded actuarial liability contribution every year. And they're saying, hey, that's gonna, if we have a big loss, which we did, you guys are gonna have to pay 12.6 million. And then 13.6 in the following year. So we have our pension trust, which we can now draw down on to pay for that UAL, that unfunded actuarial liability. So we set up this pension trust in 2017, and the idea was to provide stability, diversification of assets, and that we could smooth our rates as the CalPERS rates are going up and down. By the end of this year, we'll have contributed 10.5 million to the trust. And that has really worked out well for us. So our earnings as of July 2022 were over 1.1 million. Last year it was better. Our earnings were like 2 million, but 1.1 million is still great. And we started to draw down from that pension trust this year to reimburse ourselves for that UAL, those miscellaneous plan pension costs. And so that completes the overview and context. And I'm now going to turn it over to staff from PARS and US Bank Highmark Capital Management to give you some more detail about our trust.
Thank you, Deb. It's Deborah. I was just going to add a few things before we turn it over to Andrew and Mitch. But so the UAL that Deb is speaking about is a payment that we have been making throughout time. And she's just stating that it is going to increase based on the losses. So we have been paying this amount, and it's more than I want to talk about the way the actuary calculates it, but it just keeps growing, like all pension benefits keep growing because people keep living longer, and we do have increases in our salary, and we grow our staff. Our staff increases as well. So those are some of the things why it grows. And then the contribution from the trust that we're drawing down is just a, the $2 million is to help smooth the rates. So it's certainly not paying for the whole entire unfunded actuarial liability, but it is going to help us smooth the rates for this year and the next few years. That's all I wanted to add. So there you go, Mitch and Andrew, it's all yours.
Thank you, Deborah.
Right.
Hey, Mitch, did you want me to drive the PowerPoint?
Yes,
Okay,
please. Can you hear me okay?
Sure.
Yeah.
Great. So thank you, Deborah. It's great to be in front of the committee. Been working with the district since the beginning, so I feel like this is really close to my heart. I'm a hiker and hiked a bunch of your trails. So I'm over on a country road here in Amador County, so hopefully y'all can see me okay and hear me. So that's our presentation in front of you there. The next page. It's our contact information. There's my cell phone number if you need to reach me. Next. Just a reminder, there's 3 companies working together very closely to bring you this 115 trust program. PARS, we're the trust administrators. We do the record keeping, the accounting, and the plan compliance. US Bank is our trustee. They are the custodian of the assets, so they hold the money. Highmark Capital, our investment management partner, represented by Andrew today. We've been working together for a long time. I met Andrew my first day on the job in 2004, and we're both still here together 18 years later. So my best guess is this slide will change the next time we get together. You may or may not be aware, US Bank tendered an $8 billion offer about a year ago for Union Bank, the parent company of Highmark Capital. And I'm going to turn it over to Andrew to give you whatever any late breaking news might be in terms of the status of that acquisition. Andrew?
Well, that was a tease, especially since there's no real late breaking news. We still wait. We're still waiting for regulatory approval from the FDIC, the SEC, and the OCC. So we we need all three regulatory bodies to put their initials, their blessing next to this acquisition offer. And so far, nobody's stepped up to the plate. So we're still in waiting mode. Initially we thought it was going to get done on May 1st. That was our first cut at legal day one, and it's May 1st is way in the rearview mirror right now. So we're in wait and see mode. But until then, we keep on doing what we've been doing for you for over a decade. So we continue to march on.
All right. Thanks, Andrew. We'll let you know definitely when things are finalized. Just a reminder, this is an IRS approved trust. That's important that the earnings on the assets are tax exempt. It does have the ability to pre-fund OPEB or pension or both. And you're utilizing the pension bucket on the right, $10.7 million currently in there. Just a quick reminder, the two ways the money can be used are either to reimburse the district for pension related expenses or to pay the retirement system directly. And those are located underneath the cylinder on the right. Next. Want to give you the quick history. It began in September 2017. The general manager and the CFO are co-plan administrators. You're in the moderately conservative active strategy. This is an individual account. First contribution was December 2017, the amount of $3.5 million. And you made additional contributions of $6.250 for total contributions to date through July 31st of $9.75 million. We see investment earnings of 1.1 as mentioned. So total again through July 31st account balance 10.6 million and change. Next. Here's a graphical representation of that money coming in over time. It shows a solid funding history, continuing to build up the safety net so that it can be used when the time is right. It sounds like it's getting close. Next. These are the latest numbers from CalPERS. They literally just came out. As you know, they run 1 year behind. So even though they just came out, they represent the fiscal year that ended a year ago, June 30, 2021. And the good news was on line 2 that your assets grew 24% because they had a very good year, 21.3% return. So your unfunded liability went down overall by 30%, and your funded ratio went up to 80.8%. So that's fantastic. The range we see of agencies in California of our clients is 60 to 80 on funded ratio. You're in that upper end range. So done a tremendous job of managing the money, paying your unfunded liability, and preparing for whatever comes in the future. As mentioned by Deb and Deborah, that the returns that just happened June 30 of this year, CalPERS was down 6.1%, and this will get factored into the numbers that they will release next year. Next. All right, I'll turn it over to Andrew, and he can go through his economic outlook and performance.
Thank you. First off, big thanks for putting us at the top of the agenda. We do have a couple meetings this afternoon, so big thank you for putting us up front. With respect to the update, I'm going to give you a quick, maybe 2 to 3 minute overview on the economic forecast that we have at Highmark. Then I will talk about the performance, share with you our current positioning, and answer any questions that you might have along the way. So feel free to ask any question as you might have them. And so with respect to our economic forecast, this was as of August of this year. And so we have had an asset allocation committee meeting since August. I'll give you one modest tweak update in terms of our forecast here on the page in front of us. First off, GDP, 0.3 to 1%. Perhaps we are holding out on hope that we will be able to avoid a recession this year. If we were to go back in time to January, and in fact, I think maybe last time Randy presented to the board here, Randy probably showed GDP numbers of 3.5 to 4.2%. As we entered 2022, that's the kind of growth rate that we thought we were going to be seeing in this calendar year. And it almost seems month after month as we progress through the year we lowered our GDP forecast for the year. And it's no mystery why we did that. I mean, obviously, with the persistent high inflationary levels that we've seen throughout the economy, and I know we all see it when we go to the gas pump, when we go to the supermarket, if we're paying rent to a landlord, we cut that check to the landlord. And inflation is just very high and persistent, and it is just sucking up consumer discretionary dollars that we would put forth to buying goods or taking trips or financing services, whatever the case may be. And over time, it has put us in a situation where we are very close to this year alone in a recessionary environment. We have GDP 0.3 to 1%, but it would not surprise me at all if, when all is said and done in 2022, we were very well in a recession this year. Throughout the course of the year, we've also lowered our S&P 500 earnings. We're at a $215 to $225 level for S&P 500 earnings. Those have come down. Unemployment 3.7 to 4.2%. If there is one outlier, and in this case, usually outliers are negative things, negative factors. In this case, unemployment is a positive outlier. If there is one positive outlier, it is unemployment. Right now, unemployment is at 3.7%. If we were truly in a recession this year, instead of putting on 2 million plus new jobs in terms of payroll numbers, we probably would have seen by now here in almost October a loss of 500 or 600,000 jobs. So the unemployment numbers that we've been seeing just don't really jive with the recessionary environment. So it is kind of a head scratcher in many respects, the unemployment statistic. And 3.7 to 4.2 is where we see things winding up at the end of this year. Core PCE inflation, the aforementioned inflationary numbers, we put out a target forecast for core PCE. That is the inflationary metric that the Fed uses. I think a lot of us on this call and a lot of my other clients typically look at CPI. CPI right now is 8.6%. Core CPI is 6%. Core PCE is the one forecast that we put a forecast prediction on, 3.8 to 4.3%. Whatever inflationary metric that you're looking at, it's just high. And it is so far away from the 2% target that the Federal Reserve is aiming for to bring inflation down. And that's important because you look at our Fed funds target of 2.75 to 3.25% as of August. In our most recent meeting, we goosed up our forecast level between 3.5 to 4%. And you know what? At the end of this year, if inflation doesn't come off the boil in any way, shape, or form over the next few months, the Fed might take it north of 4% in terms of Fed funds rate. And with that, there's obviously so much pressure on the bond market. But I think that the main fear that we've really seen over the last couple of weeks is that the Fed is going to engineer maybe a significant recession, not something like 0 to minus 1%, but something that might be minus 2, minus 3% GDP contraction either this year or even next year. So much of the market, stock market, bond market is looking at what the Fed's doing. And right now, they just seem very, very hawkish. Let me pause and see if there's any questions with respect to that forecast for 2022. Okay. Director.
I guess I don't know if you can answer this question, but when we see assumptions like this, these are based on some real good research, I'm sure. And so I guess the question would be, does CalPERS continue with their assumptions of getting, what is it, there's 7, I mean, they were up to 8%. They kept saying they were going to get a year. I know they were kind of forced to say, let's be a little bit realistic, and they dropped to 0.5% or something. But do they read this stuff, or do they just, are they playing in the sky?
Mitch and I are pretty good about having poker faces when the clients are kind of punching CalPERS here and there. Sometimes, though, I will confess that I share some of the pain that CalPERS feels. In as so much as, CalPERS has to make long-term forecasts. And long-term forecasts usually are based on models. You don't want to put too much weight in a short period of time, a short cycle. And then truly, when CalPERS sort of started the concept of reviewing long-term forecasts and lowering them for their discount rate, for their expected rate of return, internally Highmark was doing the same thing. Because, as you point out, Dennis, we look at the same things. And one firm is not going to say, hey, I think I can get 12% from stocks. And another firm is going to say 7%. I mean, we're all kind of in the same ballpark. Truly, we are. And so CalPERS probably doesn't want to put too much weight in terms of a very short-term dynamic that we're seeing right now. And so I think that they certainly look at the numbers that we see. They may have a different inflation number. Our long-term inflation number is 2.5%, which we revised upwards. I think CalPERS is 2.7%, so it's kind of in the same ballpark. But neither Highmark nor CalPERS wants to drastically change a 20 to 30 year horizon based on maybe a couple quarters of either really ultra positive numbers, data, or significantly dire and dreadful numbers that we've kind of seen in the last 9 months. And I guess this is a recorded conversation, so I can't believe that CalPERS can see me saying nice things kind of about them. Oh well.
All right, thank you.
You bet. Well, in terms of dire and dreadful, let's go to the numbers. Yeah, my old eyes can't quite pick that up, but I have the paper-based format here. I was going to focus on the 1 year number. Thank you, Deb. I was going to focus on the 1 year number just because these are typically annual updates, but since me and my team have been on the case since day one, I'm happy to address any time segment that you might have a question on. And as a reminder, the column headers represent certain time segments. So we have the quarter, year to date, 1 year, 3 year, and then inception to date periods of time. Those are the column headers. The rows, if you see black colored font, those would be our performance numbers for the plan. If you see sort of a lighter brown shaded colored font, that would be some type of representative benchmark for the portfolio for the plan. And so, with respect, and by the way, this is through the end of July, so we can update it after the call for August numbers, or well, heck, 2 weeks from now I can show you the third quarter numbers as well. So in looking at the July period ending 1 year column, which would be the third column over from the left, if there's one silver lining about the Fed raising rates, is that now money market yields can make something. 0.27% has been our last 12-month rate of return for money market. Right now, our money market yields 2.17%. If the Fed does, in fact, take rates to 3.5%, 4%, we're pretty much looking at a solid 3% run rate on our cash investments. I know you don't pay me to invest your money into cash vehicles, but it is a silver lining, certainly with respect to the money that would sit on the money market line item. Really, I know that the fixed income total return for the last 12 months of a minus 9.2% is not as bad as the equity number of minus 10.9%. I know that to be a fact. But as Deb stated in her opening comments about stability and diversification, and more so with respect to stability, we came into this within this engagement thinking that, okay, well, 2/3 of the portfolio assets would be in those stable assets, the fixed income that would get us 3 or 4%. And certainly I do feel that is very possible long term, or heck, even short to intermediate term from this point forward, because I mean, good grief, corporate bonds, single A rated, 5-year maturity horizon, you get 5% easily for that. Not to mention a 2-year treasury that gets 4.2%. So starting, in this environment with yields higher, once again, the silver lining about higher interest rates, the future looks much, much brighter for bonds. The problem is the previous 12 months that got us to this point when the Fed raised rates, the minus 9.2%. And having 2/3 of the portfolio getting that minus 9.2%, I will put my initials next to this as a type of investment objective for stability, but certainly the last 12 months is not blowing that out. And so, yeah, our fixed income minus 9.2% for the last 12 months, our equities minus 10.9%. Stocks going down, equities minus 10.9. That happens probably once every 2 years. The stock market going down 10%. That's not a 100-year flood sort of thing. The bond market going down 9-10%, that doesn't happen too often. That is probably, maybe a once in every 50 years sort of event. You've got to go back to the 70s before you've seen a period of time where fixed income was so dreadful. But I do think that the future is much, much brighter for fixed income. And so too with stocks. Even if we are in a recession right now, stock market in 2023, 2024, 2025, it'll come back. Maybe I'm saying that to just encourage the body here to just stay the course within this investment objective. I know the numbers that I'm showing you for the last 12 months. When you go to the bottom of the page, 9.1% negative. It's not what you want to see. It's probably a little bit better than CalPERS. Not that that's gets us any golden star there. But I do think that this serves a purpose. Diversify in long term. It does provide stability. So certainly, I don't know what the feeling was coming into today's meeting. I know everybody knows the market's been down, but certainly I would encourage you to stay the course and not change anything within respect to the framework of this investment objective. I'm going to pause there and see if you do have questions though on any of the returns, on any of our forecasts that you see here.
Director Waspy, is it okay if I?
Pardon me, I was wondering who was going to go ahead, Deborah.
I was just going to, Andrew, I really appreciate where Mitch said you've been in this business for more than 18 years. You've seen the market go up and down, and I know this is not a tough message to deliver when you have to do this with all your clients, but we are looking at how, I think I have an echo here.
You certainly do.
I know. Maybe Andrew, can you mute for a minute and see if that's doing it? Anyways, I know we're looking at the benchmarking, and we are, we're fairly close to the benchmarking, so that's good. And then when you look at the next page on our handout, it does talk about our breakdown, and we have, like you mentioned, about 30% in equities and about 65% in fixed income, and that's that conservatively moderate or moderate range that we selected. Is that correct? Yeah. So I agree. Stay the course. This is, we're investing for long term. I absolutely repeat what you said. One of the reasons we did create this trust is for diversification. So we didn't have all of our eggs in one basket. So we're serving that purpose.
That's correct. And if you could just turn to the next page, I'll address quickly the positioning. The middle portion of this exhibit shows the asset allocation ranges for stocks at the top of the page, bonds in the middle, and cash at the bottom of the page. Equities for moderately conservative range between 20 and 40%, fixed income 50 to 80%, and cash ranges from 0 to 20%. The column to the left of the policy ranges shows our current positioning as of the end of July. I will share with you that over the last month, we have moved to a slightly more conservative allocation. Currently, we are at 28% in equities, 67% fixed income and 5% in cash. So, going from 30% to 28%, it's not a huge change within, a long-term scope of getting more conservative, but it certainly is a nod towards more conservatism, in as so much as equities probably have a little bit more downside risk than where bonds have, and that would dovetail with my comments about going forward with a 2-year Treasury getting 4.2%. We feel pretty good about the Treasury giving our money back to us 2 years from now, and we feel pretty good about getting the interest payment. So we're a little bit more inclined to add to bonds at this point, and with money market yields at 2.1, with 5% or so of plan assets getting 2.1%. I don't want to say you're paid to wait, but you're kind of paid to hide out a little bit. So we certainly are trying to practice what we preach, but 25, 28, 30% in equities, probably not going to make a huge bit of difference, but we are at least leaning towards a more conservative tilt within respect to the portfolio.
Great, thank you.
You bet. Thank you.
I think that's all we had on this item. Is that right, Deb?
Okay,
if
well,
there's
are there
any
any
questions.
questions or comments from board members?
In Texas talk, it's hunker down. And I think that's the only common sense. I still think we're taking the right approach. Look at the long term. I thought it was a wise move when we did it, and I still think it is. But it must be hard to make us reports all over the place. So you have my sympathy.
What the hardest part is? It's for moderately conservative investment objectives. The clients that are 60% stocks, 40% bonds, 75% stocks, 25% bonds, they kind of know what they're getting into, and
Yeah.
they know the risk they're taking. For clients that sort of check that box for moderately conservative, they said, we know that stocks and bonds go up and down in value, but we want 2/3 at least of our portfolio in that safe conservative asset. And I don't want to blame the Fed, but certainly the Fed actions in terms of raising interest rates has turned that thesis at least in the last 9 to 12 months on its ear. Long term, trust me, the silver lining of higher yields going forward, I feel pretty good about the prospect of bonds going forward.
Right.
And I'm sure Mitch, being from Texas, he liked that hunker down comment.
Anyone else? Hearing none. Oh, pardon me, Elizabeth. You get.
No, I wasn't. I was just agreeing. I certainly support staying the course. It makes sense. You shouldn't get nervous and start moving things around when you've got a long-term strategy. So, I think this looks good. I think the little tweaks that you all made make sense to me. So, it looks good.
Okay, and I would just add, and probably unintelligently, but you kind of stole my thunder, because somebody told me in anticipation of this meeting, somebody told me that you can get 4.2% for a 2-year Treasury note, and I'm thinking, and I'm probably wrong because my memory's really bad, but we always say we're a park district, we're using other people's money, we're in it for the long term, we're very conservative or mildly conservative, as we say now, but that's not, I'm trying to think of our rates of return in lots of our investments. 4.3%, even in the high times, is pretty good. And I know inflation's made 4.3% probably going to be nothing, but boy, 4.3% sounds really, really exciting to me at this point. Especially if our goal is just conservative protection of our wealth and making a little bit of money.
Joel Gillespie, you nailed it on the head, but you also nailed the one counter argument that one could come up with. If inflation stays at 8, I made 4, prices went up 8, I'm losing real 4. That is, so you provided both sides of the equation there. But do we all think that inflation's going to go, stay at 8%? Do we think new car prices are going to go up 8% every year Do we think Chipotle burritos are going to go up 8% every year? No. I'll speak for myself, no.
I agree. Well, great, thank you. Are there any members of the public that have any comments or questions? All right, if not, Andrew, thank you very, very much for your presentation. It is a little sobering, but I think, yeah, obviously staying the course is the way to go, and I'm glad we've got professionals like you and your people to help us out.
Thank you for letting me present today.
All right,
Yes,
thank you very much.
Bye-bye.
Okay, our next item is the Green Bond Annual Report.
All right, I'm going to share my screen again.
Okay.
And yes, this is an annual item that we bring to you to tell you about how we've spent our green bond funds. And this is a report that we are required to do because we've done certified green bonds. When we issued our bonds, we did certified green bonds. So we're required to do this report every year and put it up on a website, the MSRB website. And so we bring it to you also just so that you can see how the funds are being used. So just recapping our green bond issuance. So back in 2017, we issued $30 million of the total $80 million issuance as green bonds. And this was a kind of new thing for a local government agency to do because we did like land use green bonds. So we had to do some special defining of what our green projects would be. And so those were land acquisition, habitat improvement, sea level rise response, and trail creation. So all the projects that are using WW funds that are green in this way, land acquisition, blah, 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 we can use our green bond money for, and then we report out on it. And then when we have projects that are not those green ones, we can't use the green bond money. We use our other WW bond money. And so that's things like recreational projects, parking, restroom, visitor centers, et cetera. So those are excluded. And so we have some careful accounting so that we can make sure that we're using the right money for the right projects. So as of the end of last year, we had spent 28 million, so 93% of that original 30 million. And now we're going to start drawing down on so we did a new WW issuance in February of this year. And so now another $30 million of green bonds. So now we're going to start drawing down on those funds. And in future reports, you'll see us reporting out on those bond funds. So the report goes into detail, and it's in your packet, about what expenditures, green expenditures we had in 2021. And then we have a page for each completed project where we're reporting out to the people who bought our bonds. So ostensibly there's somebody out there who bought our bonds and they're really interested, like, what is my money going for that's really helping the environment? So we report out on the different projects, and these are just a couple excerpts. So one that we used green bond money for was our Civic Rancho Meadows acquisition at Deer Valley. And so that was 80 acres. And you can see we, in 2021, we spent 733,000, but in total 1.5 million. And then we list out what was the significance of that. And then the calculation we do, the expected carbon sequestration, is based on a 2016 study that's still on the district's website of all the different kinds of land that we have at the district and how much carbon is sequestered by each of those different land types. And so we calculate, okay, so 80 acres of rangeland, each acre is sequestering like a little bit less than 1 ton. And so based on that 2016 study, we say, all right, each year that land, that 80 acres is sequestering about 73.3 tons of carbon dioxide. And it's different for each type of land, whether it's grassland or forested land, et cetera, or marshland or whatever. There's like 10 different types. And then here's another project that was completed. And this was the Naval Weapons Station acquisition. And in total, we spent about 839,000 of green bonds. And that's a much bigger area, so 2,540 acres. So that's sequestering about 2,325 tons of CO2 each year. And that is it. This is an informational item, so no action is required.
Any questions or comments? from board members? Director Eccles.
Yeah, first of all, thanks very much for the report. I love the idea of having special green bonds for our projects, and I'm thrilled that we were one of the first local agencies to do that. My question is this, I'm just curious. So with the green bonds versus the rest of the bonds, oh, sorry, I don't know why it is that every time I talk, my phone starts. But anyway, so I just want to make sure I understand, like when we issue these bonds, is the interest that we pay the same as the other bonds, or is it different for the green bonds versus the rest of the bonds?
Yeah, I can take a crack at that, and Deborah, you can jump in also. So we were hoping to see a difference, and that we've heard anecdotally that there's starting to be more of a demand for green bonds in the market, which means people would be willing to pay a slightly higher premium. We did not see that in our 2022 issuance. So they came in like almost exactly the same. In the 2017 issuance, interestingly, we did see a slight premium for the green bonds. And so the hope is that that's gonna, going forward, people would be willing to pay more, but it didn't happen this time. I couldn't tell you why. It could be like timing of maybe other agencies coming to market at the same time as us, and it's all supply and demand driven. So, but we did not see a difference this time.
Okay, thanks.
Well, yeah, I thank you, Deborah. I'm glad we're doing this. And I hope there is a greater demand for these, because it is the right thing to do. And thank you. I mentioned last year, whenever we did this last time, we could explore more opportunities for green bonds, and I'm sure you guys did that. So I appreciate that. And well, let's keep going forward. Are there any comments from the public? Hearing none, we thank you very much for the report, and we can move on to Beacon Economics property tax forecast. Oh boy. Here we go.
All right, so your last informational item, again, another annual item. So we work with Beacon Economics every year to get a 5-year projection of where they think assessed value is going to go. And then again, to give you some context, so we first started working with them back in 2009. That was after Measure WW had just been passed. And suddenly, I guess it had started happening in 2008, like the Great Recession was happening, and it was really impacting real estate. And so we got our first, so we were very concerned about how we had made the promise to voters that we would keep the tax levy at under $10 per 100,000 of assessed value. We had just issued all this new debt, and how are we going to structure this debt so that we can keep that promise to voters? So we worked with Beacon Economics, and this was their first projection. I'm just showing you the high and the low forecasts, and it was pretty dire. So it was negative 4.7% for sure in 2009, and then a range of maybe as good as negative 6.3, but maybe as bad as negative 7.8. It didn't end up actually being as dire as they had forecasted, but this was the one time, and it was when I was just starting at the Park District, that we actually did see a decrease in our assessed value and property tax revenues. So it can happen, but good news, it's not expected to happen. In the 5-year forecast we just got from Beacon, they are not projecting that kind of negative scenario. That was just to give you context. So the highlights from the report, which is in your packet in its entirety, and they give us kind of a hierarchy. They start out giving us some federal overview, then they look at the state level, and then they look just at the 2 counties, which is what we've asked them to do the projection on 2 county assessed value. So at the federal level, they believe, so they're a little bit rosier than what Andrew just said, that they think, so GDP has been negative for the first 2 quarters, but they're saying they expect that with data revisions, the GDP might be actually become positive, so erasing any signs of a contraction. They gave us this report in August, and new data is coming in every day, but that's what they said in August, is that they were thinking maybe at the federal level, GDP is not as is not going to be as negative as it was originally looking. So it was, and I just looked actually before we did this presentation, it's still negative. It hasn't been revised to be positive yet. Negative 1.6 in Q1 and negative 0.6 in Q2. Then looking at California, they said just, and they say this every year, that California is so restrictive in its housing construction that it drags economic growth. The flip side of that is, again, a supply and demand issue where you have less supply, prices go up. And so that has really benefited the East Bay, where there's not enough housing. Everybody's wanting to move to the two counties. I mean, not everybody, but there are more people wanting to buy houses. And so prices have continued to go up. So that's the flip side of that housing shortage. Even though it drags on economic growth, it actually tends to help us in assessed valuation and property taxes. And then another excerpt from the report, just looking at the East Bay, they're saying personal and household incomes remain strong, and they believe that current homeowners will be able to continue servicing their mortgages. And so what that means is they're saying, unlike in the Great Recession, when suddenly people were forced to sell their homes at a loss, they don't think that's going to happen in this current downturn. They think people are going to be able to keep their jobs. They're not going to be forced sellers. And so assessed value, it's not going to increase as much as it did, but it's not going to be a complete drop off. So here's the comparison of last year's forecast with this year's forecast. And I'm calling it the baseline forecast. So they give us three scenarios: low, baseline, which is like medium, and high. So this is comparing the baseline, like the medium forecast from both years. So you can see the red line, it was 2021, and they were projecting that it was going to go up to 2020 in 2023, 24, and then it was going to come down to like an average of a little higher than 5% was where they thought things would sort of settle out over the next few years. And then the blue is the latest projection. And so they're showing that we're going to see a decline. It's still like above zero, but the increase will not be as strong as it has been. So this year we're looking at a 7 to 8% increase, and it's going to be more like 2% when we get into 24 and 25. And then it's going to bounce back up, but they're setting the baseline to be a little bit lower, maybe closer to a little above 4% in the outer years. And each year their forecast is different, like they're always gathering new data, but it's helpful to compare the 2 years. So our practice with Beacon is that we get the three forecasts, the low, the baseline, and the high. We almost always use the baseline forecast. And we will do that again in this year's budget projections. So we have our known assessed value increase from the two counties. So because the counties are on a fiscal year that ends June 30th, and we're on a calendar year, we only know the numbers for the first half of the year. We know our increase is going to be 7.7 and 7.8% from Alameda and Contra Costa. And then we use Beacon's forecast for the second half of the year. And so that is 4.2% for Alameda and 6.1% for Contra Costa. So we combine that and we're looking at an increase of 7.6% for our property taxes in 2023. And then just again, for giving you more context, these are the three projections that gave us low, baseline, and high. So their low is 1.5%, baseline is 5%, and the high is 8.4%. And that is the last slide, and stop sharing. Anyone have any questions? Or Deborah, yeah.
I'll just say, so as we all know, when there is changes in the economy, the assessed valuation kind of lags, right? So those changes take a couple of years to hit us. But the projection is that we are going to continue to grow, but at a slower rate. I was just looking at what the current year's growth rate was, and it was on property tax, it was 7% for this current year's budget. So, even a little bit higher on average for the 2023 projections. So we'll have to see if this all this economic craziness is showing up in a future year, which is kind of sometimes what happens with property tax revenues. Thanks, Deb. Great report.
Thank you. Any questions, comments from board members? Yeah, thank you for the report. It sounds like an interesting couple of years coming up. Any members of the public have any comments? Okay.
Dennis, well, we do have
We have a,
oh, I'm sorry. Go ahead, Shannon.
sorry, we have a public comment, not on the agenda, from Darcy Meadow.
Okay. Well,
I'm
that
sorry,
is-
Meadow Darcy. I'm so sorry.
That's quite all right. That is in fact our next item of business. So we will move to public comments and welcome Meadow.
Hello, everyone. Can you hear me okay?
Yes.
Okay, great. New headset. I just wanted to thank you. My name is Meadow Darcy. I'm the chair of the Deferred Compensation Committee. And I just wanted to thank the board and especially the Finance Committee, as well as district management for ensuring that we were able to attend the conference this year for NAGDA. Myself, Ben Guzman, and Eric Holmes were able to attend. I'm not sure if any management employees or other employees were able to attend virtually, because we didn't really know that. We couldn't really connect that way. So I'm not sure if that happened, but it was a wonderful conference. We learned so much stuff. There's going to be some really great things that we're going to bring back to the committee. And I think I'd also recommend to the committee that we give a short presentation to Board Finance to update you on some of the things that we learned. So just wanted to say thank you very much.
Great, Meadow. Thank you very much. And I'm laughing a little bit. That's a requirement of us when we go to conferences. We're supposed to come back and give a report. So I think we'll welcome that report.
That's right.
At the Finance Committee and or in the committee, the Pension Committee, and or pardon me, the Deferred Compensation Committee, and also the Finance Committee. So thanks very much.
Great. Thank you.
Thanks, Meadow.
Any other public comments from anyone? My goodness gracious. What about committee comments? Committee members' comments?
Just thank everybody for all of the information today. Very, very informative and very efficient as well today. So we got a lot of information in a short amount of time. Appreciate it.
Yes, Director Eccles, we're giving you a nice, easy meeting this time as we gear up into budget season.
Oh,
So
a warning.
yes,
coming.
the October meeting will have a preliminary look at the budget. And then, of course, the November meeting will go through the entire proposed budget. So more to come.
Fortify ourselves is what
Yes.
she's saying. Anyway, I was glad everybody stays calm through this. And I think that's what we need to do in this era of don't get too excited, wait and see what happens. Honestly, you'd be foolish not to. I think we get good advice and I think we're smart enough to keep it. So thank you very much for staff and all the presenters.
Yes, I agree. Thank you all very much. Anything from staff? Anybody for the good of the order? Hearing none, I guess we're adjourned. Thank you all very much. Take care.
Thank you.
Thank you. Take care.
Thank you. Thank you, Deb, for doing all the heavy lifting today.
Yes, yes,
She
yes.
had all the items. It
Well, nobody was aggressive or nasty to her though. So, okay.
was all good. Well, good to
Good.
see you, directors.